Hello, welcome to Hedgeye NexGen, where we're going to help you break down finance to its simplest form. As well, we're going to help the younger and newer investors build their wealth. Today, we're going to be focusing in on diversification. The way I think of diversification is really it's about like knowing who you are and like what works for you, because like everybody's going to be different and how where they want to put their money. Some people are a lot more risky. Some people are a lot not risky at all.
Averse,
yeah, risk adverse. Like I mean, honestly, my wife, she hates seeing red, right?
Right.
So we had like ours. I'm like I don't mind it as much, right? So ours is just what works for us is we have to have some things that are a lot less risk averse, like and so forth. So I think that's the first major thing is know what kind of works for you. Like, are you a very risky person or are you not? Because that's going to tell you really where you should be putting a lot of your stuff in your money. Okay. The next big thing is like the S&P 500 runs everything.
Yeah.
Okay. So like basically all the S&P 500 is the 500 largest companies in the U.S. Okay. It basically covers about 80% of the U.S.'s total market cap. Like when people say this is the market, like that is the market.
Yeah.
Like, you basically you either want to be in line with S&P 500 or a little bit above the S&P 500. Like that's like the index.
It's baseline. Baseline is the S&P.
Exactly. So everything needs to always be based off of the S&P 500. Okay?
Yeah.
So that's the first major thing to understand when just even starting off. Like S&P 500, that's the thing, right? Okay. And everything's based off of that. Okay, so but here's all, and then that's where we start to get into in the S&P 500. There's like different sectors. Okay, so it's broken up into its different parts, right? You have technology companies in there, something called consumer discretionary, which just think of that's like where consumers are like spending a lot of money, like their discretionary money. So like Amazon, right? Yeah, people buy packages with that money.
Yeah. Industrials.
Yeah, okay, yeah. So
energy.
Yeah, I was thinking of something else. But yeah, financials is another sector. Healthcare is another sector. Right, financials like banks. Financial and healthcare is like Procter and Gamble or like a Johnson & Johnson, Pfizer. And then there's energy companies. They like dig up crude oil and like they power your houses. You also have, like you were saying, industrials, materials, and utilities is another major one.
Yeah.
Okay? So basically S&P 500 is the market, and then it enters stocks, and then that's broken up into all these different parts.
Right.
Okay. So now let's just say we look at the top 20 largest companies in the S&P 500. So just so you know, 6 of those names are tech companies.
Yeah.
Okay. Next 3 are consumer discretionary. There's 4 financial companies, 4 healthcare companies, and 1 energy company.
All right.
So, well, and then the others, they are not in the top 20. But tech is the major dominator. And if you even go to the top 10 companies, 6 of them are tech.
Right.
So 6 out of the 10 largest companies are tech.
And the largest is tech. The number one is NVIDIA, right?
Yes.
Yeah.
No. Number 1 is Apple.
Oh.
And then I believe it's NVIDIA.
Okay.
Well,
either way, both tech.
Yeah.
So tech is running it right now.
Yeah, tech runs it right now. And then there you have one consumer discretionary company, which is Amazon, which is half tech, half consumer discretionary now.
They blanket a lot. Yeah.
And then you have 2 financial companies and then 1 healthcare company.
Okay.
And so it's pretty tech driven, which is, I think, pretty important because that, like, when you're thinking of like, oh, why does everybody care about the tech companies and so forth? I think maybe they don't know this or they do know this, but they're favoring the tech companies because they know that that's where there's a lot of potential returns. Yeah. That's where the largest companies are in our world. Okay.
Yeah.
Okay. So that's the first major thing there, and then so now let's just go. We will have like a couple of just very basic charts, but we're gonna have to talk them through because most people are listening. So
okay. Yeah, for sure.
So we'll go to the first one. So first one here. So this is basically Here you go. Very basic. Okay, so S&P 500 is the S&P 500. That's at the top. Basically, all I did was, let's say you had $1, and then you invested it into the
only the S&P.
Only the S&P 500.
Yeah. No diversification.
No diversification at all.
So, sort of, but no.
Yeah, right. You would have today $7. And this is if you invested on 3/10 of 1999. Okay?
Yeah.
So in 1999, you had $1, you'd have $7 in the S&P 500, which
not bad.
No, not bad at all, right?
It's the benchmark.
Basically, that is, yes, exactly. Okay, so then the next one is NASDAQ. So that's a tech position. So then if you invested $1 today, you would have $11.
Yeah,
$11 is more than $7.
Definitely.
Okay, and so that's a very large return, and so that's so in tech you would expect to get more return for your $1.
Yeah.
Okay, so the next one is XLY, which is $9. So you'd have $9.25. Okay, then it goes industrials is $8.70. Then materials is $7.90. Then XLV, which is healthcare, you'd have $7.87. And then you get the energy, you'd have $7.20. So all of those would be above what the S&P 500
returns
return
over the same time,
over the same exact time frame. And then the ones that are lower are your consumer staples. So that's consumer staples, you would have $5.50.
Right.
Financials, you have $3.80. Okay, so basically what that's just to show you. So basically, when you're thinking of diversification and knowing what works for you, the ones that return the most, so your NASDAQ, consumer discretionary, industrials,
right?
Yes, they return the most.
Yeah,
but also you have to understand that they're also going to have the largest potential drawdowns.
Yeah, well, highest volatility.
Yes,
right?
It's the highest volatility. So let's say the S&P 500 goes down 15%.
Yeah.
Tech might be down 30%, 35%. And when you're thinking about your wealth, right? If you're put, you're working your 9 to 5, you worked 2 years to get all this wealth.
Right.
If you go 100% into the NASDAQ and then you lose 35% of your money, it's
not good.
It's not good. It's going to hurt a lot, and it's probably it could take over 3 years for you to build that back.
Yeah.
Right. And so that's one of the biggest things. Yes, the tech has the most returns, but you really have to be careful to not lose that money. I think maybe next episode we'll go into compounding and drawdown math, because that's on top of all of this.
Right.
It makes good stuff with that.
Yeah, I agree.
But so that's the number one thing, where on the ones that are lower, so like consumer staples, right?
They're steady.
They're very steady. They're not like if let's say the S&P 500 is down, I don't know, what did I say, 15%? These might be down 10%, 5%, right? But the trade-off for that is that you're not going to return as much, right? So you're losing less on the in the long run, but you're getting the fact that it's not going to go down tomorrow by 100%.
Yeah, sort of like an anchor for your portfolio, right? You will avoid the really big drawdowns that tech experiences.
Exactly,
and just keep your money.
Yes. Yeah. And then based on where you are in life, like you can take different amounts of risk, right? Yeah. Somebody that's retiring tomorrow probably not going to have 100% of their money in tech, because if it does go down by 35%, well, you lose 35% of your wealth.
Right. Right before you're going to retire.
Right before you're going to retire. Nobody wants to work, so that's another 3+ years.
Right, exactly.
Of working. So when we're talking about diversification, the whole point is understanding where are you on these returns.
On the risk meter.
It's basically a risk meter. Exactly. And then you decide, basically you allocate your money based on that, because, hey, some young kids, they'll want to be in 100% tech.
Right, yeah. Like, why not?
If you're okay with that risk, then you're okay with that risk. You should, but understand, here's the potential drawdown of that is any day, not any day, but you can lose 35%. Like, yes, you're accepting that you could get more returns, but it can backfire.
Yeah.
Right. And so and one of the biggest things with like building wealth, and like one of the biggest, like, essentially, like, what's the word? The biggest thing that can set you back when you're building wealth is having these drawdowns.
Yeah.
Actually. And so,
like you mentioned, it takes longer to actually get back to break even than you may think. And
yes, exactly. Like, it doesn't go back to break even tomorrow. Like, it's time.
Yeah.
You need time, and it will. But like somebody will point out, well, yeah, that tech chart, that included the crash of 2008. That included the 2000 tech bubble, right?
And COVID.
Yeah, it included COVID, right? So, like, yes, it does include all of that, and over time, but we'll show you in the next episode, if you avoid those drawdowns, that number goes
higher, through
through the roof.
Yeah.
It is like, it's night and day.
Oh, yeah.
And so we'll show that in the next episode, but let's go to, so that's the overall arching
idea
setup of it, right? But now each one of those ETFs of those major industries, they have single stock equities, okay?
Right.
So now we're going even further onto the risk curve, right? So if we go to the next slide, people will be able to see this, okay? So we're going to start with the top. So this is from 1999 again. So from 1999, you had $1. You invest in the S&P 500, you have $7. If you invested that $1 into the NVIDIA, you would have $6,052, which is unbelievable return. I mean, most of that return came in the last, like, last decade or so.
Yeah.
Okay. Apple would have been your next one. You would have $790. United Healthcare would be the next at $135. Then Amazon at $70. Eli Lilly, that's a healthcare company, $23. Home Depot, $18. Microsoft at $17. Berkshire Hathaway, massive conglomerate, kind of like a financials, $11. JP Morgan, you'd have $9. Johnson & Johnson, you'd have $7. Procter & Gamble, you'd have $7. And ExxonMobil, you'd have another $7. So all of those would outperform the S&P 500, okay? But the ones that are returning the most are dominated by a lot of tech and some healthcare.
Yeah.
But NVIDIA, but this is why people are obsessed with NVIDIA.
Right.
Because the
Look
returns
at the return. I mean,
were unbelievable, and a lot of people made a lot of money off of it. And so, but here's the thing, right? Risk can happen with these. So yes, NVIDIA, it's like a single stock can be up that much, but you really have to be careful because it's a single stock.
Yeah.
Right. And so what can happen?
Super volatile.
Very volatile.
Yeah.
Like you could lose like 30% in a day.
Oh yeah.
If an earnings report goes wrong.
Right.
And earnings happen
4 times a year.
4 times a year.
Yeah.
That's
a lot. It's opening yourself up to a lot of risk. And I think you also have to mention that when you're picking single stocks 25 years ago, you have to be the best stock picker in the entire world to go long all of these things and then carry them for 25 years and they return this. I mean, there's so many other companies that didn't do anywhere near this or went bankrupt.
Exactly.
You can't just dump all your money into single stocks and hold them forever and they're all going to go up like this. That's not really realistic.
Exactly. And companies go out of business, right?
Yeah.
Like that's
many.
Kind of one of the major point. Like
you lose all of your money.
Blockbuster Blockbuster was massive. It probably would have been close to the top of the list.
Yeah.
And then now it's zero.
Yeah.
Right. And you lost all your money if you had 100% in Blockbuster.
And it's not coming back.
Blockbuster is not coming back. Yeah. Netflix has taken their spot.
Exactly.
Right. So that's another big risk with the single stocks. Mm-hmm. You can't they might be in flavor right now. Like chocolate ice cream is really good, but like maybe people start to hate on chocolate ice cream for some reason.
And you don't know. I mean,
and you have no idea.
You don't know. The indexes don't go away, so it's safer. Single stocks most volatile, most risky. Then indexes broken out by sector, a little better.
Yep.
Not as good than just buying like a sort of a market fund. and you could buy a couple market funds, and that has you super diversified across pretty much all sectors. You can even go globally as well. You can do international. So we'll get into that later, but exactly. Yeah, I mean, so that's basically the name of the game, is to either avoid risk or take on as much as you want.
Right. And like that, I more believe in like giving people the tools to understand how much risk you're taking on, because then the individual could be like, okay, I'm a very risky person. I would just say, like, don't do 100% in one of them. If you want a tech portfolio, then like you can put some money in tech, but understand if tech goes down, you could lose 30, 40, sometimes 80, 90% of your money.
Yeah.
And it's going to hurt a shite ton.
Yeah.
We'll finish this list though. Okay, so then we come down. These are just companies that came into existence after 1999. So this starts on June 28th of 2010. That's actually my birthday.
Let's go. Wonder why you chose that day.
It's also the day that Franz Ferdinand. So that's the guy
was murdered.
Yeah,
starting World War I.
So I started World War I.
The Archduke
Franz Ferdinand got murdered on June 28th.
Oh yeah,
that started World War I, and so I came into this world with a bang. Also, the day Tesla IPO'd. So
wow, really?
We have a little bit in common there.
Wow, what a day in history!
It is a great day in history.
Top three events on that day: you, Tesla, and Archduke Franz Ferdinand.
I mean, what's better than that?
Incredible.
I mean, do you have anything cool on your birthday like that or no?
Groundhog's Day.
Okay. So
a holiday.
Well, you determine though, like people's, like if winter's going to be longer or shorter. Like,
yeah, I don't know.
Every year.
I don't know how he's probably about as good as that, the groundhog, as I am at picking single stocks. So.
Actually, funny with the groundhog. That story, I believe, originated in Italy. And they used a hedgehog, and there's this winery out in the Tuscan region it's like Ricci is the last name.
Of course.
Of course. And so like they used to use a hedgehog, and the guy would use the hedgehog to predict weather. And essentially it's Ricci. And
that's you.
And that's me. So
yeah.
It
just came full circle right there.
Yeah. I guess so. I guess I control the weather now too.
That was incredible.
Yeah, they thought he was a witch, and then
they thought the hedgehog was a witch?
No, the guy, because he was so accurate, they thought he was a witch.
Oh, wow.
And he lived in a cave.
It's a valuable hedgehog.
Yeah. Well, yeah, because I don't know.
Anyway.
Cold weather, I don't know.
Something.
Groundhog Day is pretty cool. You determine.
Yeah.
Every year, cool. You determine something.
Yeah.
Even though you could be wrong every year.
I think he's mostly wrong, but
30% or so.
Yeah.
Okay, we'll go back to this.
He should diversify.
We need more hedgehogs.
But anyway,
all right,
your point.
Back to this chart of, here we go. Okay, so these companies started about 2010. Mm-hmm. Okay, so we'll go S&P 500 would have given you $7, right? Because everything always starts with the S&P 500. What is your return versus the S&P 500?
Yeah,
you can't beat it.
Join it.
Might as well join it.
Yep.
Okay, Tesla would have gave you $193. Broadcom would have given you $115. That's a semiconductor. MasterCard would have given you $26. Visa would have given you $17. Meta would have given you $15, and Google would have given you $13. Okay,
mm-hmm.
So
beating, but
yes.
Then again,
best
stock picker ever,
right? And so this is where it's like, because I know our analysts would tell you, like on Tesla, like they had a major hype,
mm-hmm.
And now they're going to probably lose their hype because they're really just a car company, or they're not a tech company. And they were trading like a tech company. Now they would argue they're going to be trading like a car company, which you do not get those returns for.
No.
So that's the overall danger of just putting it all in Tesla, is that like those trends happen over time, and
a lot of people do that, and it doesn't end up well for a lot of them.
Not end up well.
So.
And I think you also came up with a great point, is that like we don't know what, like in 20 years what's going to be at the top of this list.
Yeah, no clue. Probably nobody knows. Maybe Warren Buffett knew one of them, or like 5 of them, or something.
Maybe,
but nobody knows.
That's the whole point. It's like nobody knows, right? And so what's working today not going to work doesn't have to work tomorrow, but I would also just say, but if you're like, oh, I can predict the future, and I'm going to go into all these small companies that I think are going to replace all of these companies.
It's a good way to lose your money.
It is a great way to lose your money.
Yeah, it's a fun way to lose your money.
It's a very fun way.
You'll have a good time doing it, but you'll end up with no money.
You'll end up with no money, right? So that's, again, understand what you're getting into.
Yeah.
Those companies I just mentioned, those are the even more riskier than these large cap companies, because like these large cap companies at this point are most likely not going to like
go to zero.
Yeah. Some of them might, like maybe 1%,
over
10%,
time. Yeah.
Right? But like they're not going to like go to zero.
They won't go to zero tomorrow.
Right?
You're going to be fine, but you also missed a lot of the return, most likely.
Yeah. Yes. Yeah. But those really small companies, those could go to zero.
Easily.
Very easily. So it's, again, just understand where you are on the risk curve. And if you want to take a shot at one of those, like I'm one of those guys that I'd say, like, go for it.
Yeah.
But, like, don't put 100% in. Like, put in a percentage that works for you.
Right.
But understand what you're getting your ass into, because like I don't want anybody to lose all their money, but I do want you to compound your money in a health and safe manner.
Yeah.
All right, we go to the next one. So that's all stocks. Okay. What we now need to talk about is bonds, gold, everything else. So, okay, let's start with this top one. So we're starting in 1987. Okay, in 1987, if you had $1, okay, you invested in S&P 500, you'd actually have $47. Okay, reason why? So people might be asking, why was the previous one $7 and this one's $47 all of a sudden? Well, we gave it an extra 12 years of compounding, and that's why we always say start compounding early.
It goes back to our other episode, compound early and often.
Compound early and often.
It'll build on itself.
Exactly. So that's what's going on there. Okay, gold would have given you $6. Home prices would have given you $5. So that's like when you buy a home.
The dollar.
The dollar would have given you $1.05.
Yeah.
Okay.
Interesting.
Crude oil would have given you $3.80.
Getting absolutely smoked by the market, all of them.
Yeah. So I think this is an important one on crude oil. So, and commodities in general. So, okay, commodities are like cycles. They go up and then they go down. They go up and they go down. They're not really supposed to go
up over time.
Right? And so that's a very important thing to understand with oil.
Yeah.
And so that then dollar, like, it's very hard to look for all currencies, right? Yeah. When your major currency is the dollar and it doesn't go up over time, right? So that's like where a lot of people say gold is a currency, and that's because it's actually taking the market share from the dollar. That's what a lot of people would say.
Still cyclical, though.
Yes. But yes, I would say gold should go down less than the S&P 500 over time. That's what that showed.
Yeah.
Home prices are also stable, right? And this doesn't mean that, you should not buy a house.
Yeah.
But it's also, you should understand that the returns in the stock market are higher than the returns you should expect in a house. So if you can't buy a house right now, but you have $1, which means that you can buy the S&P 500.
Yeah.
Put that dollar in the S&P 500, and it should outpace home prices over time.
That makes sense.
Okay. So I said that on crude oil. I think the other really major point on this is that people will get angry me showing this, but really it's that different things and different assets can go up more in certain periods of time. So if you looked at like a 12 or 6 month window of like today, should I have been in gold or the S&P 500 or tech, right? Gold might have won. Gold, I
think gold does win that.
I think gold won this last 6 months.
Yeah.
Right? But
which is not the norm.
It's not the norm.
No.
But these types of periods can happen and do happen.
Yeah.
Quite often.
Yeah.
Okay. And so that's very, very important to know, is that like in very short periods of times, like bonds could outperform.
Yeah.
Gold can outperform.
Yeah.
But over the long run, what's proven to outperform all of them is stocks. And that's why a lot of people care about the stocks a lot more than anything.
Highest returns, but also highest risk. It's like everything's the same, it just...
Exactly. exactly. And maybe somebody who's retiring might be more interested in the currency bet, which would be the dollar because, well, it doesn't go down.
No.
Like, let's go back to our previous example. S&P 500 is down 15%. Dollar might be down 1 to 5%.
Yeah.
Which you could make up
quicker. Much quicker.
A lot quicker. So that's very important.
Yeah.
If we go here, we'll go to this. Now, this is why people love Bitcoin. Bitcoin. So we'll go to. Okay, yeah, we'll do 2002 for S&P 500. So 7/26, 2002. You invested $1 in S&P 500, right? Always start with S&P 500. You'd have $10 today. Bonds, which I measured by TLT, would have $2. And Bitcoin would have $837,704.
Nice. That's crazy.
That right?
Yeah.
Absolutely.
It's like that story of the guy who like bought a pizza in Bitcoin or whatever in 2010, and that pizza's worth like, $1 million now, or like $5 million. Hilarious.
Yeah. But this is the obsession with Bitcoin. You almost don't have to go any further. That's why so many people our age love Bitcoin, is because this is what we saw. And so I love Bitcoin too.
Yeah.
It provides
insane
and crazy returns for now.
Right.
But that's the thing, is it could fall out of flavor.
It could go to zero.
It could go to zero. Like Bitcoin is one of those that in literally 2 months' time, it could go down 80% in 2 months.
Yeah. Highest returns, highest volatility, biggest drawdowns. So, it's all the same game.
The most amount of hurt, too, with biggest drawdowns, I think.
Yeah.
Anything. Big. That was good. That was a good one-liner.
Oh, they all relate. It's all the same thing with just different levels of. It's like different bounds of where it can go and where it's most likely to go.
Exactly.
As you get smaller and smaller on the risk gauge, you're going to make less probably, but you're also definitely going to lose less. Exactly. Unless like aliens invade and blow up. I mean, it'd take something literally insane for housing prices to go to zero. Like 50% down. It would be insane. So it's all about your risk gauge. And if you really want to put all your money into Bitcoin, which like people do, and they've made these returns, like, I would say probably sell it now and just cash that out. But a lot of people really believe in it. And
but like even like going all in on it, like I think that's the opposite of what diversification means.
Exactly.
And so like you know what? Maybe they got lucky. Maybe they knew.
Once in a lifetime.
Maybe they knew.
Opportunity in Bitcoin. Like once in humanity opportunity.
You get these types of opportunities, whatever.
Yeah.
But here's the thing. Bitcoin of 2010 was different than Bitcoin of today.
Completely.
2010.
I bought a pizza with like 5 Bitcoin. It's crazy. It's like $5 million.
But like nobody knew about Bitcoin. Is like nobody knew about Bitcoin. Or you would go and you would walk to somebody and be like, you should buy some Bitcoin.
Yeah.
And it was like $1,000.
Yeah.
People would be like, what the hell is Bitcoin?
Like, why would you waste your money on that?
You're right. Like, what is this? It's just digital.
Yeah.
Then people would always go into this blockchain rant about what blockchain is. But anyway, that's very different. Now you ask people, what is Bitcoin? Everybody could tell you what Bitcoin is.
Yeah.
Right? So what Bitcoin was and what Bitcoin is today is two very different things.
The exact same as those single companies 25 years ago.
Exactly.
So
Exactly. Right? Like, Blockbuster could have had those returns.
Yeah.
I don't know what Blockbuster's returns were, but I just know they went to zero.
Yeah.
But anyway.
They're gone.
So it's a great point, right?
Yeah.
And so you just like things change. Yes, this math helps you understand the risk rate, like the risk and where you are in a risk gauge. Mm-hmm. And if you're investing in Bitcoin, just understand that's the most risky thing in the world that you could be investing.
You're maxing out your risk gauge if you're investing a lot of money in Bitcoin.
You're at like a 12.
Yeah. I mean, it doesn't even register on my risk gauge. So you just have to be aware of that.
Be aware. And then I should say anything on like the altcoins.
Oh boy.
Then you're even more off on the risk gauge. And that's like investing in a hope and a dream.
Yeah. That's like buying an NFT that, it's
like a lottery. It's not even a lottery ticket. Well, because like then people think they can win, but it's more like
I don't know.
It's more like gambling because nobody ever wins gambling.
It's exactly like gambling. Yeah.
Yeah.
It's great. Yeah, it's like for fun. It should be for fun. You could put some money in for fun, but that shouldn't be your
exactly. Exactly.
In altcoins.
Exactly.
I mean, it can be if you want it. We're not going to tell you what to do, but this is just our advice on diversification. We believe it's the best strategy. Yeah, it is.
But hey, I'm a pretty risky person, and I love having fun.
You are.
So you know what? Like, if I want to carve out a 1% position in something,
go for it.
And I know I'm going to lose all my money in it. Then, like, you know what?
You're fine with it. You're fine with it.
I knew what my risk range is, not risk gauge was, and that I made a dumb choice. And I can look in about a year and see one's at 0, and maybe like Nvidia's up 100.
Yeah,
right? And that's on me for being an idiot.
Yeah.
But,
and you knew that going in.
Exactly.
That's the main.
Know what you're doing going in.
Yeah.
I should say something on dividends. Mm-hmm. Okay, so like dividends are essentially 4 times a year, a company will pay out a dividend
for owning
their company. So you own some shares, and then they'll pay a dividend
per share.
So, and different companies pay out different dividend, like higher or lower dividends.
Yeah.
And really, all you need to know is like Visa has a really large dividend.
Yeah.
Most of the time, what happens with a high dividend company is you'd expect their price appreciation to be a lot lower. Okay, so it's like a guaranteed return. It's almost like a bond.
Yeah.
In a way, like you get your guaranteed return, not guaranteed. You get your return,
no matter what
but don't expect a big price appreciation. So they're a little bit more stable companies. The higher you get on that, basically, they're not growth companies. Like a tech company probably doesn't have
purely growth company.
Yeah.
And that's a different way to compound your money. Like you reinvest the dividend. There's a lot of people really love that. That's a whole different kind of strategy. Well,
when you're old, like a lot of older people love it because what happens is it's almost like a paycheck. They treat the dividend as a paycheck. Where I would say like you can also just sell some stock and that could be your paycheck.
True.
But you know what? They like their dividends. You have any other questions on this? That was a lot of what I had on diversification. Do you have any follow-up questions?
Yeah, I would just say if you were to provide some super basic guidelines, if someone's like, all right, I'm starting my portfolio, I want to be diversified, would you say like put some S&P, put some in an international fund? Is there any sort of like really, really general guideline someone could start off with when they're trying to diversify?
I think a person like that needs to understand themselves first. And so I would first say go into the S&P 500, watch it, and when it goes red, if you're feeling a lot of pain, you know where your risk is.
Yeah.
And the green, right? Like, so do that almost. And test yourself out.
Yeah.
And like you need to create your own parameters, essentially, right? And if you go into a tech company, okay, like when you start off going into a tech company, like maybe put in 2%.
Yeah, and then level yourself up if you're okay with it.
Okay, am I okay with this? Because it's going to go down maybe 5% in a day. If you're okay with it, okay, you can go and broaden out into more tech companies. But first make sure your wealth is doing something.
Right.
So you can start with S&P 500. You can start with the Qs, understand that, and then just test yourself out. Like I know our CEO, what he does, he's older than us. In ETFs, he like 6% max position of his total wealth.
Right.
Single stock equity, I believe, is like a 3% position.
That's the max.
That's the max that he would ever go to into a single stock. Yeah. Right. So that's what it is. So I would say
you can make your own.
Figure out yourself, but it is a trial and error game, and just don't go 100% into a single stock equity or Bitcoin to start yourself off. That is a recipe for disaster.
Yeah. And I think that's good. I mean, I really like that idea of putting yourself in the S&P, seeing how it is on red, and then if you really don't like it, put more and more into something more stable. Yeah. So you avoid the bigger drawdown.
Exactly.
Yeah, I like it.
Exactly. Test it out and learn yourself.
All right. Well, I think we'll wrap it up here, and then next time we're going to go into some drawdown math, which I'm pretty excited for. Yeah. It's really interesting. I think a lot of people don't know about this, so I'm really excited.
At all. And then we'll go into compounding too.
Oh boy.
How to compound.
And why it's so important.
Yeah, exactly.
All right. Well, Ryan, this has been an absolute pleasure once again.
Thank you,
Glad to have you back in the studio. And everybody keep writing in those questions, and we'll answer them. And have a good one.